Have you ever just stared at your screen and wondered why the market suddenly moved aggressively on absolutely zero news? Well, if you've been following along, you already know the market doesn't always move because of headlines. Welcome to part 4 of our 8-part explainer series on options market mechanics. Today we are looking exclusively at the calendar. Consider this explainer your ultimate guide to reading the mechanical forces of time itself. We're going to break down exactly how the relentless ticking of the clock and scheduled events mechanically force options dealers to buy or sell. All right, let's take a quick look at the agenda for today. We've got 5 massive concepts to hit: the OPEX cycle, the intraday fuel of zero DTE options, the clock-forced flow known as charm, the volatility-driven force of Vanna, and finally, the earnings IV crush. Let's get right into it. Starting off with Section 1, the OPEX cycle, basically the monthly heartbeat of the market.
So, OPEX, or options expiration. This hits on the third Friday of every single month, and it acts like a massive gravitational pull. Enormous open interest just builds and builds at these monthly strikes, and as we get closer to that date, dealer gamma peaks. This massive accumulation of gamma sets up our very first calendar-based mechanical force, and it completely changes how the market behaves depending on what side of the third Friday we're actually on.
Think of this stark physical contrast here. Heading into OPEX, if dealers are long gamma at big strikes, it's like the market gets locked inside a compression chamber. Ranges compress, and the index orbits those massive strikes because dealers are forced to fade every move. But once that third Friday passes, all that open interest expires. That massive gamma stabilizer completely vanishes over the weekend. Because of this, the Monday or Tuesday after OPEX is statistically one of the most volatile windows in the entire calendar. The market violently unclenches and ranges break, and it's not because of some new information, but simply because the stabilizer was removed. Moving right along to Section 2, Zero DTE Intraday Market Fuel, the daily reset.
Okay, here is the absolute crucial point you have to remember. Zero DTE is reloading fuel, not one-shot fuel. Right? These 0 days to expiry options totally dominate index volume today, and their gamma is absolutely enormous because they only have hours to live. But their lifespan is just one single session. A massive put position that causes an afternoon sell-off today will completely evaporate at the 4 p.m. close, and the whole structure just reloads fresh the next morning.
Because of this dynamic, you get these fierce intraday physics that just reset daily. This often causes violent whipsaws around big, round strikes, especially late in the day as gamma basically goes vertical. But here is why this matters so much for your own trading process. Because of this daily reset, zero DTE completely pollutes your aggregate gamma exposure, or GX, maps. If you are a swing trader looking for multi-day moves, you absolutely must strip zero DTE out of your data. You have to look only at the monthly and quarterly expiries. Otherwise, yesterday's dead fuel is literally ruining your read on the market's true direction. Now, before we get into the second-order Greeks, let's clear up a mystery that drives traders absolutely crazy. Have you ever watched a quiet market slowly, almost painfully, just drift up into OPEX week for literally no reason at all? Like every dip is instantly bought, but there's no real news driving the strength? Well, the answer is in Section 3, charm, or clock-forced flow. Let's talk about delta decay.
So charm is delta decay. Basically, it measures how an option's delta changes purely as the clock ticks, even if the actual stock price hasn't budged an inch. Think about a classic setup. The market is sold off, investors are loaded up on out-of-the-money put protection, and dealers are short those puts. As the clock ticks closer to expiry, if the market doesn't fall further, the deltas on those out-of-the-money puts start bleeding towards zero. This mechanically forces dealers to buy back their short hedges day after day in a completely knowable direction.
What's really wild here is how the clock alone forces the dealer's hand. That mechanical decay creates this persistent drip upward bid that just intensifies as expiration approaches. It doesn't need a single new buyer to push the market higher. It is literally just dealers unhedging. This flow peaks in the final week before a big expiry, which is exactly why you see that relentless slow grind upward drift into OPEX. Okay, so that covers the clock. But what about volatility? Like what happens when a massive, highly anticipated event, say an inflation print or a Fed meeting, passes with no actual good news, just the absence of disaster, and yet the market absolutely rips upward anyway? That brings us to Section 4, Vanna, where volatility moves markets through the IV crush. Vanna is the measurement of how an options delta changes purely because implied volatility, or IV, changes. When market fear evaporates and IV drops, the deltas on out-of-the-money options mathematically shrink. Dealers who are short those options suddenly have less risk on their books, meaning they are forced to buy back parts of their short hedges. Vanna links market fear directly to mechanical dealer flow.
Let's walk through exactly how this builds into the classic Vanna rally. Step 1. A feared event passes and implied volatility drops. Step 2. Out-of-the-money put deltas instantly shrink. Step 3. Dealers are mechanically forced to buy back their short hedges. And Step 4. The market rallies on absolutely zero fundamental news. Bears will scream all day that the move is fake because the news wasn't actually good, but the news didn't cause the rally. The mechanical unwinding of hedges did.
Finally, let's look at Section 5, the earnings IV crush, dealing with event volatility.
Right before an earnings announcement, implied volatility inflates drastically to price in the anticipated gap. But the literal second that earnings number hits the wire, the uncertainty collapses. Boom! Because of this, near-dated implied volatility gets crushed by a massive 30 to 70% in a matter of minutes.
And this sets up the ultimate trap for retail traders. Because of that violent IV crush we were just talking about, if you buy long, short-dated options heading into earnings, your options suffer a catastrophic loss in Vega value the second the news is out. Because of that, the actual move of the stock must completely overpower the implied move that was already priced into the options just for you to break even.
So the big takeaway here is that pre-earnings options are basically priced for a Category 5 hurricane. If the stock moves 5% in your direction, but the market had implied an 8% move, yeah, your calls are opening lower the next morning. It's not rigged. You were just directionally right, but suffered a massive volatility loss because you bought insurance at peak prices right before the storm passed. This is exactly why professionals generally trade the volatility crush around earnings, rather than simply guessing the direction.
As we wrap up this explainer on the calendar's mechanical forces, you have to remember the golden rule of the options market machine, straight from our source material. Dealers do not have opinions. They simply have inventory, and hedging that inventory is a forced, predictable flow. The OPEX cycle, charm, Vanna, none of these are mysteries. They are just dealers reacting mechanically to the ticking clock and changing volatility. Which leaves us with this final critical thought for your own trading process. If you now understand exactly when the clock and volatility will mathematically force the market's hand, unpinning ranges, driving drift, or triggering massive post-event buybacks, why in the world are you still guessing based on the news? The footprints are right there on the calendar. Thanks for joining me for this explainer, and I'll catch you in the next one as we continue breaking down the mechanics of the market.